Hey everyone, and welcome back to the AI Tech channel. Today, we're diving deep into Palantir Technologies, a company that's been making waves in the AI sector. But the big question is, where will Palantir be 5 years from now? Will it be sitting on top of the AI world, or will the hype finally fade? Some analysts are even suggesting that Palantir could be worth more than Salesforce by the end of next year. That's a bold claim, considering Salesforce currently has a market cap roughly $52 billion larger than Palantir's. But is it realistic? Let's find out. But what if it's all just smoke and mirrors, a massively overvalued stock on the verge of collapse? We're going to unpack the data, analyze the trends, and give you our honest assessment. Get ready, because this is going to be a wild ride. Okay, let's start by comparing Palantir to Salesforce. Both companies operate in the enterprise software space and are benefiting from the AI boom. However, their approaches and trajectories are quite different. Salesforce has traditionally grown through acquisitions, building an end-to-end software suite by integrating companies like Tableau and Slack. But lately, investors have been demanding more organic growth and profit margin expansion. Salesforce has delivered on this promise to some extent, but the company has struggled with consistency. Sometimes they exceed expectations, and other times they leave investors scratching their heads. This inconsistency makes me a bit skeptical about Salesforce's long-term dominance in the AI space. Their focus on agentic AI, for example, faces stiff competition from Microsoft, a much larger company with deeper pockets. And let's not forget the numerous tangential competitors like Monday.com, HubSpot, and Workday. It's a crowded field. This begs the question, can Salesforce truly navigate this competitive landscape and emerge as a clear leader in the AI revolution? Now, let's turn our attention to Palantir. Unlike Salesforce, which is battling numerous competitors, Palantir is partnering with tech giants like Microsoft, Meta, Amazon, and Oracle. This is a huge advantage. The fact that these companies are choosing to work with Palantir rather than launching competing products speaks volumes about the strength of Palantir's technology and its potential for growth. Palantir's biggest driver of growth is its artificial intelligence platform, or AIP. This software suite is helping businesses integrate generative AI capabilities into their operations. And the demand for AIP is soaring. This strategic approach positions Palantir as a key enabler of AI, rather than just another competitor in a crowded market. And that's a crucial distinction. Partnering with the giants instead of fighting them? That's a smart move in the cutthroat world of tech. Looking ahead, Wall Street analysts are predicting significantly less revenue and earnings growth for Salesforce compared to Palantir over the next 2 years. This suggests that analysts see more competitive headwinds for Salesforce. Now, it's true that Salesforce is a much larger company, and at some point, its growth will naturally mature. But AI is supposed to be a transformative opportunity for businesses of all sizes. The relatively mundane growth profile for Salesforce makes me wonder if Wall Street shares my suspicion that AI may not be as influential for the company as it could be for other software businesses, like Palantir. For these reasons, I expect to see continued inconsistency from Salesforce. On the other hand, Palantir's prospects look strong. I think investors will continue to cheer on the stock, potentially driving its valuation even higher. So, could we see Salesforce's market cap contract while Palantir's expands? Absolutely. And if that happens, Palantir could very well emerge as the more valuable business by the end of the year. Speaking of soaring valuations, Palantir shares recently reached a new all-time high. Even amidst a recent sell-off in the tech sector fueled by concerns about Chinese AI startups, Palantir has bucked the trend, becoming the highest-performing stock in the S&P 500 this year. But why is Palantir defying gravity while its peers are stumbling? The key is demand for Palantir's AI product suite is not only strong, but accelerating. And the company is consistently achieving high levels of operating leverage. This means their profit margins are widening, strengthening their cash flow and liquidity. These strong unit economics give Palantir a huge advantage over its competitors, many of whom are still burning cash or not growing nearly as fast. But can this incredible run continue? Or is Palantir's valuation simply unsustainable? To answer that question, we need to analyze Palantir's valuation. And here's where things get interesting. Palantir has consistently exceeded Wall Street's estimates, which is impressive. But it's not uncommon for top-tier growth companies to do that. So, we need to dig deeper. When we benchmark Palantir against other leading software companies in the data analytics and security spaces, a clear anomaly emerges. Palantir's valuation is significantly higher than its peers. Its price-to-sales ratio is more than threefold the next closest comparable company. And when you factor in profits, Palantir's valuation looks even more stretched. It's currently trading at a price-to-earnings multiple of over 600 and a forward P/E ratio of roughly 200. These numbers are eye-watering, to say the least. It is also important to consider the impact of dilution on these ratios, as equity compensation is a significant expense. So, is Palantir's valuation justified, or is it a bubble waiting to pop? While I applaud Palantir's ability to compete in the intensely competitive enterprise software market and carve out lucrative niches in the AI realm, I think its valuation has become disconnected from reality. It's hard to see a company doing roughly $3 billion in revenue trading at a market capitalization of over $260 billion. Now, I'm not saying Palantir's prospects aren't bright, but the ongoing momentum in the stock should make investors think twice about where shares could be headed in the long run. As time goes on, expectations are likely to be exponentially higher with each passing earnings call. This puts Palantir in a somewhat unenviable position. The company could have a terrific quarter but still not live up to lofty and unrealistic expectations, triggering a potential sell-off. So, what's the verdict? While I believe in Palantir's long-term vision, my candid opinion is that the stock is overvalued today. I think Palantir is more of a stock to trade than buy and hold. If you're a long-term investor looking for exposure to growth stocks in the AI sector, there are more prudent options than chasing the momentum in Palantir at this moment. Now, let's zoom out and look at the bigger picture. The demand for AI software is projected to skyrocket through 2030 as more businesses adopt this technology to boost efficiency and productivity. One estimate suggests that global spending on AI software could nearly quadruple between 2024 and 2030, generating annual revenue of over $391 billion by the end of the decade. This massive growth potential is a significant tailwind for Palantir. Last year, Palantir's revenue grew by 29%, and its customer base increased by 43%. More importantly, existing customers are increasing their spending on Palantir's offerings, as evidenced by its net dollar retention rate of 120%. Palantir's management has emphasized that AIP is a key growth driver, fueling new customer acquisition and expansion opportunities. As customers experience the benefits of AIP, they're likely to sign bigger deals with Palantir as they deploy AI into more areas. This positions Palantir to capitalize on the explosive growth in the AI software market. Another positive sign for Palantir is its strong contract backlog. Its total contract value shot up an impressive 56% year-over-year in the fourth quarter of 2024. And its remaining deal value, which is the total remaining value of contracts that the company is yet to fulfill, jumped 40% to $5.4 billion. This remaining deal value is well above the revenue that Palantir generated last year, suggesting that the company's growth is likely to accelerate in the long run. Moreover, as Palantir gets more business from its existing customer base, it's ideally spending less money to acquire new revenue, leading to robust growth in its margins and earnings. For example, Palantir's adjusted operating income jumped by 11 percentage points in 2024, and its bottom line shot up an impressive 64%. Analysts expect strong growth in Palantir's earnings for the next couple of years as well. All of this suggests that Palantir may be able to outpace Wall Street's earnings expectations over the next 5 years. But there's still that pesky valuation to consider. Palantir stock is trading at a massive premium following its incredible rally. It trades at over 100 times sales and has a trailing price-to-earnings ratio of over 600. There's no doubt that Palantir is on track to make the most of the massive opportunity in the AI software market. Its numbers are proof that it is indeed gaining ground in this space. But the valuation seems a bit detached from reality. The only way Palantir can justify this valuation is by consistently outperforming consensus expectations and displaying further acceleration in its growth. The good news is that Palantir does seem capable of doing that, given the pace of its customer additions and the increase in the size of contracts that it is signing. Also, the company seems set to grow at a faster pace than the AI software market over the next 5 years. All of this could translate into more upside in Palantir stock in the long run. But investors who are looking to buy the stock would do well to assess their risk profile, as its sky-high valuation opens up the possibility of a sharp dip in the stock price if any cracks appear in its growth story. This is something investors should not take lightly. There are always risks involved. Now, let's consider a more optimistic perspective. Could Palantir become an era-defining company, like Microsoft, Apple, or Amazon? Palantir CEO Alex Karp believes his company is a software juggernaut, and there are growing signs that he might be right. In its most recent quarter, Palantir's U.S. revenue alone increased by 52% year-over-year, with commercial U.S. revenue growing even faster at 64%. This suggests that American companies are eagerly adopting Palantir's AI-powered platform to improve margins, increase customer satisfaction, and grow sales. As Karp puts it, the business we have built has now developed its own internal momentum and strength, its own interior life and forms of untamed organic growth, with the output that we are seeing far surpassing what we are investing. Like the mega-cap tech names before it, there seems to be a rush for organizations to get their hands on Palantir's AI-powered platform. While there are concerns that Palantir's valuation is too rich, just like Amazon in the early 2000s, valuation may not be a helpful lens in this case, assuming the company in question is forging a new path that can deliver decades of growth. It's becoming easier to see why Palantir might be doing just that. However, let's not get carried away by the hype. While Palantir is firing on all cylinders, it's important to remember that financial gains are worth only so much. The increases in Palantir stock have appeared to exceed that growth by nearly every valuation measure. Investors could dismiss the trailing P/E ratio of over 530 since it has only earned a profit for a relatively short amount of time. But the forward P/E ratio, which is now above 200, indicates the stock price is years ahead of its growth, despite a 116% rise in yearly net income. The company's price-to-book value ratio of 51 is arguably the most blatant sign of overvaluation. Although the S&P 500's average book value multiple of 5 is at multi-year highs, it's still a tiny fraction of where Palantir's price-to-book value ratio stands. Palantir's book value multiple has even caught up to NVIDIA, one of the best-performing stocks in the AI industry. Such a level could imply limited upside in the near term. Palantir has found a successful market niche in the AI software space, and investors should expect its revenue and profits to grow at a rapid pace for the foreseeable future. But this prosperity has probably caused Palantir's stock performance to become unhinged from the underlying business. So, what's the bottom line? Is Palantir a buy, a sell, or a hold? The answer, as always, is it depends. If you're a long-term investor with a high risk tolerance and a strong belief in Palantir's vision, then holding onto your shares might be the right move. But if you're a more conservative investor or you're concerned about the company's valuation, then it might be time to take some profits off the table. Palantir's future is far from certain. The company faces intense competition, and its valuation is extremely demanding. But it also has a unique technology, a growing customer base, and a massive market opportunity. Ultimately, the success of Palantir will depend on its ability to execute its vision and deliver on its promises. That's the question that investors need to consider. The coming years will reveal whether Palantir is truly an AI juggernaut or just another overhyped tech stock. And remember, even with the most thorough analysis, the market can always surprise you. So, do your research, assess your risk tolerance, and make your own informed decision. And don't forget to subscribe to the AI Tech channel for more in-depth analysis of the latest trends in artificial intelligence. Thanks for watching.